Today is December 31st, and as the world transitions into the final day of the year, the silver market is reflecting on a period of intense and sudden price volatility, as silver stands at $72 this morning as I am making this video. The recent drop in the price of silver from 83 to 73 was not caused by the discovery of a new ocean of supply or a sudden disappearance of industrial demand from solar factories or electric vehicle manufacturers. The decline was fundamentally driven by a change in the rules of the futures market when a margin hike was implemented by the exchange at a very sensitive time. This technical adjustment forced a rapid and automatic liquidation of positions that left many traders facing a fast and ugly exit from their investments. During the previous week, the price of silver had climbed into the mid-80s before the exchange decided to increase the amount of cash required to hold certain contracts. When traders returned from the weekend, they found that they were required to post significantly more collateral immediately to maintain their long positions with leverage. If a trader is unable to provide this extra cash, their broker will sell their position at whatever price the market offers in that specific moment. This event was not a mystery or a shift in the global macroeconomy, but was instead a margin squeeze designed to manage risk within the exchange system. A silver futures contract acts as a powerful leverage tool where one single contract represents thousands of ounces of the metal without requiring full payment up front. Instead of paying the full value, the trader posts a fraction known as margin, which serves as a performance bond to prove they can survive market volatility. When the exchange decides to raise the margin requirements, it changes the financial landscape for every participant overnight and forces brokers to recalculate every account. If the account does not meet the new requirement, a margin call is issued, and the broker will liquidate the position without any negotiation if the cash is not found. When thousands of leveraged traders are forced to sell their holdings simultaneously, it does not lead to an orderly discovery of the true price of the metal. The result is a stampede, where the sell button is pressed out of pure necessity rather than a change in conviction regarding the value of silver. These types of drops often look like steep cliffs on a price chart because they lack the natural breathing of a normal market pullback. Forced liquidation does not allow for buyers to step in or for sellers to test different levels because the selling continues until the forced participants are finished. The timing of this particular margin increase was especially impactful because it occurred during the thin year-end stretch when liquidity is naturally lighter. Lighter liquidity means that the same amount of forced selling hits the market much harder and triggers stop-loss orders with greater ease. This creates a fast-building cascade where prices fall more rapidly than most human participants can react to the changing conditions. One of the most important lessons for anyone involved in this market is that they are trading the rules of leverage as much as they are trading the metal itself. Most people, unfortunately, learn this lesson the hard way when a margin increase reaches directly into their trading accounts and removes their positions. There are two primary numbers that every trader must watch, which are the initial margin required to open a position and the maintenance margin needed to keep it. When volatility begins to spike, these numbers can jump very quickly, and they do not affect every market participant in the same way. Large institutions typically have access to credit lines and treasury desks that allow them to move the necessary money in a matter of minutes. In contrast, smaller retail traders often struggle to wire fresh cash instantly, especially during a holiday period when banks are operating slowly. Consequently, the market tends to liquidate the least liquid participants first, which creates a structural feeling of unfairness for smaller investors. The chain reaction begins with a small price dip that trips stop-loss orders, which then become market sell orders that push the price even lower. This lower price then triggers more margin stress, which forces further liquidation in a self-feeding spiral that can move an absurd amount of paper ounces. This activity represents a massive movement of paper claims rather than the actual physical movement of the metal from one vault to another. Because the futures price serves as the global benchmark, these paper claims can drag the screen price down even if the physical market remains unchanged. It is entirely possible to see a world where the price chart is screaming downward while the real-world sourcing of silver stays extremely tight. This divergence is not a contradiction, but is a result of the specific structure of the financial markets and how leverage is managed. Eventually, physical reality becomes the final judge, and if the paper price drops far enough below the physical price, buyers with real cash will step in. As we move further into the start of December 31st, it is clear that arbitrageurs will eventually seek to close the gap between paper and physical prices. Although delivery rules and financing can slow the process, a significant discount becomes attractive bait for end users and deep-pocketed accumulators. The central question following a margin flush is whether the forced selling has handed a discount to the very buyers who need actual ounces of metal. If this is the case, then the crash of today can quietly transform into the rebound of tomorrow as the market seeks a new equilibrium. For anyone who uses leverage, the only true defense is to maintain enough slack in their account to survive sudden changes in requirements. It is dangerous to assume that the margin requirements of today will remain the same tomorrow, because they usually jump when it hurts the most. The official reason provided for these margin hikes is risk management, as the exchange seeks to reduce the risk of a default during high volatility. While this explanation is grounded in reality, it is also true that risk management and price impact are essentially the same action with different names. Raising margin requirements reduces total buying power and forces certain positions to close, which changes the flow and the price of the asset. Silver has a consistent habit of seeing these tools used at the most sensitive moments of a price rally throughout its long trading history. History serves as a warning label that many people choose to ignore, even though the patterns tend to repeat across different decades. When silver prices go parabolic, the rules often tighten and margin changes hit the market to break the momentum of the rally. This mechanism was clearly visible during the post-crisis money era, when silver approached its historical highs and faced repeated margin increases. The market was squeezed and the move reversed sharply as the story shifted from one of scarcity to a cautionary tale about speculation. In the late months of 2025, silver began to surge once again, and the exchange raised margins more than once in a single month. The latest increase took effect exactly when the market was thin, which has led many to question the incentives of the participants involved. If large institutions hold heavy short positions, a sharp rally can be very damaging to them, and a margin hike provides a window of relief. This does not require a complex conspiracy, but rather follows basic human behavior, where those under stress seek a way to relieve the pressure. When a wave of forced selling occurs, the control shifts from the sellers who have lost their positions to the buyers who have cash. Real fundamental shifts in the supply and demand of silver do not typically happen in 15-minute avalanches or during a coffee break. While mines cannot triple their output before lunch, paper claims can be created or dumped at the incredible speed of modern algorithms. This is why it is essential to separate the paper price of silver from the actual physical condition of the metal in the real world. During a margin flush, the paper price might drop while headlines scream and social media enters a state of panic. However, the physical market, including coins and bars, often does not follow the same downward path as the futures market. Sometimes physical premiums will widen, or dealers will hold their prices steady because inventory is tightening as buyers rush to buy the discount. If silver had truly lost its value overnight, physical sellers would be undercutting each other to move their products quickly. Instead, we often see firmness in the physical market, which suggests that the world is not rejecting silver, but is merely purging leverage. This purge is significant because it changes who is left holding the exposure to the metal as ownership moves from weak to strong hands. Leverage is a powerful force on the way up, but it shatters when the rules tighten and positions are forced out of the market. While a margin crash is terrifying due to its violence, it can also be constructive by clearing out unstable positions. The current drop might not represent a change in the long-term trend, but could instead be a necessary purge before the next leg up. Silver has a unique talent for teaching the same mechanical lesson in different decades, as seen in the episode of 1980. In that year, the price did not simply reverse on its own, but rather the rules tightened to restrict buying power and force an exit for the exposed. As we proceed through this December 31st, we can also look back at 2011, when silver surged and volatility spiked significantly. During that period, margin requirements were raised repeatedly in a very short span of time, which created a sequence of forced exits. Knowing this map of historical events helps a trader to stop being surprised when the same patterns emerge in the modern market. If the physical market remains tight, the overall market can split between a volatile paper price and a stubborn physical price. When this split becomes wide enough, it forces a resolution where either the paper price rises or physical availability completely dries up. Both of these outcomes are difficult for those who need the metal, and they are the opposite of what a typical negative headline implies. The current drop should not rewrite the bigger story in your head, but should instead rewrite your understanding of the market battlefield. Silver is not only a commodity, but also a stress test of trust, and every margin hike is an admission that leverage is a danger. No exchange bulletin can rewrite the underlying fundamentals of silver as a strategic industrial input for the modern world. The solar industry relies on silver for its conductivity and reliability, while electric vehicles use it in power electronics and charging systems. Data centers and electronics also require silver for high-performance components, and the global grid upgrade cycle uses it in switching systems. This industrial demand is not a fleeting trend, but is deeply embedded in the hardware that powers our current technological era. On the supply side, most silver is produced as a byproduct of mining for other metals such as copper and zinc and lead. This means that silver production cannot respond quickly to a change in price because the pipeline for new mines is incredibly slow. Permitting and capital expenditures take a long time, and ore grades often decline while politics can intervene in mining operations. When the world consumes more silver than it produces, the inventory is drawn down and the entire system becomes much more fragile. In such a fragile system, paper events become even more violent because there is less of a physical cushion to absorb the shocks. Geography also plays a role because large portions of silver refining and manufacturing are located in the Asian markets. When physical metal flows toward these end users, it is no longer available to satisfy the various promises made in the paper market. If exporting jurisdictions prioritize their own domestic industries, the global availability of silver can tighten further without warning. This tightening might not show up instantly in a futures price candle, but it eventually appears in delivery stress and inventory drains. The recent rally was not fake, but was instead highly leveraged, which made it vulnerable to the sudden shock of a margin hike. The real question for the year of 2026 is what happens now that the excess leverage has been shaken out of the system. Traders should watch 4 specific signals, which are physical premiums and inventory levels at major warehouses and exchange vaults. They should also monitor delivery behavior to see if more contracts are demanding actual metal rather than rolling over their positions. Finally, global price alignment is a key signal because arbitrage will always try to close any significant distortion between regions. Those who were unleveraged or held physical metal have learned that volatility is mostly noise unless it changes the supply and demand picture. Large players in the market often benefit if they can cause enough panic for retail investors to sell their holdings into a price hole. One should not anchor their brain to a single day of price action, especially when the cause is purely mechanical in nature. A margin hike does not create more silver in the ground, nor does it reduce the production of solar panels or electric vehicles. If the fundamental setup of the market remains unchanged, then the primary question is about timing rather than the ultimate direction. Expect further volatility and attempts to shake the confidence of investors as the market searches for a true bottom after the liquidation. As we look forward from this first moment of December 31st, remember that the disciplined buyer watches the constraints, while the amateur only watches the candles.